There's a new innovative way for you to hedge your exposure to the stock market when you invest, where you're protected some on the downside. Now, you give something up. Is this the right strategy for you? Should you consider it? It's not for everyone. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Should you hedge your exposure in the S&P 500 or as you're investing, should you hedge your exposure? Now, psychologists tell us that humans, we have a stronger emotional response to a loss than we do to a gain. So therefore, the emotions would be stronger if we lost 20% than if we gained 20%. This is Daniel Crosby, PhD, and he works in the finance industry, psychologist as well, does a lot on behavioral finance, says this is one of the reasons why you and me are inherently bad investors, because our emotions get in the way. We'd rather avoid a big drop than have a big gain. And that's you've got to, for long-term investing, you've got to expose yourself to those drops so that you can get the long-term gains that we've seen over centuries. So now, if you're a trader, I've talked about this before I get into this hedging concept. There's three types of investors out there, okay? And I'm using that term loosely because I would actually say you're a trader where you like to trade individual stocks, or you like to do lots of trading. Maybe you're doing swing trading, something like that. And you should have stop losses in place. And this is not a video on that. So if that's you and you're trading individual stocks, you like to look multiple times a day and you're trading in and out, you're gonna put stop losses in place just because you know you've gotta be able to hedge against a big drop. So that's you. But this video is more so for investors, which are those of you that are wanting to pick great investment strategies, great investments within those strategies, and then ride them for the long term, okay? All consistent with your financial plan. So this idea is for you, but it's really for that third category, which is savers. Those of you that are savers, you don't like taking a lot of investment risk. You're saving into low risk CDs or munis or bonds or something like that. And then you might be a saver and say, yeah, but I need to put something into the stock market. It just makes me nervous, because I need to have that long-term growth, because income is just, these low-risk investments are providing absolutely no return. So I need to get some exposure to the stock market, but I really want to limit my downside. This idea is for you. So how's it work? What is this? This is an innovative way of doing ETFs. That's what they actually call them. They call them defined outcome ETFs or innovative ETFs, and also a buffer strategy. I think it's more of a hedge strategy, but check it out. Here's how it works. It's an exchange traded fund. So it's like a mutual fund, except you can buy and sell it all throughout the trading day, okay? But these are 1-year contracts. So yes, you can buy and sell, but when you buy into the investment, let's say the August investment, you bought into the August investment for, let's say, the S&P 500, and your investment goes mostly into the S&P 500. But inside the exchange traded fund, I think they're buying and selling 6 different tranches of call options and put options so that you cap your upside potential over the next year, and you limit, or you have a buffer with your downside protection. Doesn't limit it, you just have a buffer. So for example, the power buffer, I think is what they call it for the S&P 500. These ETFs now come in S&P 500, they come in NASDAQ, they come in small cap, they come in international, they come in emerging markets. So they've got a lot of diversification now. But as an example, I think the power buffer for the S&P 500, you are invested in an exchange traded fund that's exposed to the S&P 500, but there's a cap on the upside of, let's say, 8%. So over the next year, 1 year later, okay, from August 1 to August 1 the next year, if the S&P 500 is up 8%, you're going to be up 8%, okay, minus a fee. If the S&P 500 is up 15%, you're going to be up 8% minus that fee, okay? But then in order, the trade-off for limiting your upside is the first 15% in this example. The first 15% drop, you're buffered from, you're not exposed to. So if 1 year later, on August 1 compared to August 1 the next year, if the stock market's down 5%, you're going to be even. You're going to be even, okay? If it's down 10%, you're going to be even. If it's down 14%, you're going to be even. If it's down 16%, you're going to be down 1. Okay, all of that, and then minus a fee as well. So that's how it works. You limit your upside, but you're protected on the first. They've got it in 10% or 9%, I believe, downside protection, 15% downside protection, and then they have an ultra buffer where you're exposed to the first 5% down, and then you're not exposed to the next 30% down. So that's how this works. You're capping your upside, but you have some protection on the downside. So not for you traders, and I would argue probably not for you long-term investors, at least not a large amount. This might more so be for you savers that have to expose yourself to some long-term investments to help you reach your financial goals. So that's a little bit of how it works. Is this for everyone? Absolutely not. Why? Number one, it's complicated, okay? And Warren Buffett says you should never invest in something that you don't understand. So it's complicated. I would argue, don't just go out and jump into this because, oh, that sounds good. I'd be willing to protect my downside and give up some upside. Okay, I'll do that. Okay, no, just be careful. This is complicated. Second, I see there's a time where you might want to consider, some of you might want to consider investing like this. But then there's also a time when you absolutely would not want to do this. Let's talk through a couple of those circumstances. If the stock market just had a 30% drop, would you want to invest in something where your upside potential is capped? No stinking way. That would be dangerous. That would be extremely dangerous. So to me, this is not an all-weather type of investment strategy. To me, something to consider maybe if the stock market is at all-time highs, or maybe it's approaching overheating, or we've had a long bull market and there's a lot of concern that things might just start tightening. Like now is when you might want to consider it. But this has got to be a more active strategy because I don't think it's just set it and forget it. Again, after the market's had a drop of 15%, 20%, something like that, you would not want to cap your upside. You would not want to cap your upside. Third reason it's not for everyone is it's confusing all along the way, right? So these are 1-year option contracts. Now but you hold the exchange traded fund each and every day, and you could sell it each and every day. But if you're invested in the August, then your experience that you get the first the up 8% and you limit the first 15% down, that's only looking at it once a year from that August to August. That's it. All along the way, your experience, you're going to be moving with the market, and that can be very confusing to you investors. So let's say that you're invested in that power buffer where you're exposed to the first 8%, but then you're capped on the top 8%. Well, if the stock market surges 10%, are you going to be up 8? No, you won't. Because you're only going to be up 8 if the stock market's up 10% after a year. So if the stock market surges right after you buy it, surges 10%, you might be up 3 or 4. You're not going to be up that 8. Same thing on the downside. If the stock market all of a sudden drops 10%, well, that's well within your buffer. So you shouldn't be down anything. Well, the truth is that's within your buffer a year later. If it's already after the first month down 10%, there's a good chance it might be down, it might break through that buffer floor, and your investment's probably going to be down 3-4%. Okay, so your experience all along the way can be very confusing. It's just the 1 year later do these contracts actually produce their defined result. That can be very confusing. But then the real reason why this isn't for everyone, again, is it limits your upside potential. And so you're cutting off that compound interest, that power, you're cutting it off at the knees. Therefore, work with your certified financial planner. If you're a saver and you say, I am not comfortable with the markets, but I do need to save and take some more risk to try to get more return, talk to your certified financial planner about maybe adding a little bit here. If you're a long-term investor, I would encourage you, I wouldn't mess with these. Work with your CFP though. Maybe there's a little bit that you should use for diversification reasons, something like that. Maybe if you're approaching retirement or in retirement, maybe you should buffer some at certain times, but gosh, not at all times. And if you're a trader, like I said, you're not even considering a strategy like this. But it all needs to work within your comprehensive financial plan to help you achieve your long-term financial goals. So it's a new kind of strategy, new investment hedge, if you will. So work with your CFP on that, see if it's right for you. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. You can also find us wisemoneyshow.com or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.